But I'm going to go ahead and jump in here to my slides. And, we're not just going to be looking at this presentation. We're also going to be looking at some charts because I do want to show you what this has look like on candlestick charts going back quite some time. So we're going to do both. We're going to take a look at the statistics, the data around bear markets, market corrections. We're going to look at the charts. And you're going to leave here with an understanding of what the difference is between bear markets, market corrections. You can see here I have my objectives. I am a former teacher, former principal, lifelong educator. My heart is as a teacher. The one thing that I'm learning about myself, the longer amount of education, is that I'm a teacher by heart. And so I always want to make sure that I'm very clear about what our goals are here tonight. And so, again, I want you to understand that difference between a bear market and a market correction. And what we're then going to do is look at the data that differentiates bear markets from market corrections. So there are specific drawdown points that when you hit those percentages, they tell you that, hey, this is a bear market, this is a market correction. So we'll get into that. And then we're going to look at the current markets and really look at what the status is in terms of the definitions and see where we are. Okay. And we'll also talk about, what is it right now that is dragging down on the markets? What is pulling them down? I'm sure you've all heard the T word, the tariffs word. So we'll get into that. But that's everything that we are going to cover here this evening. And we're going to jump right in. So you've probably heard the term bear market. All right. And basically, the terms bullish, bearish, I'll assume that everybody knows that who's in here tonight. A bull market goes up, right? And typically the market is in a bull market the majority of the time. But every so often, you're going to have what is known as a bear market. Okay. And if we look at the traditional definition of a bear market, it's a decline of 20% or more from all-time highs. Okay. So if you look right now, just by definition, at the SPX, the S&P 500 index, which is the top 500 most profitable companies traded on the US stock exchange, you can see that we've traded down 10%. We have not reached 20% or a bear market. And if you're asking when was the last bear market that we've had in the S&P 500, you would have to go back to 2022. And that is when inflation started running higher as a result of all the stimulus from COVID. And what happened was the Federal Reserve had to raise interest rates. That put pressure on stocks. And there was a drawdown that lasted about 8 months where we were in a bear market. Okay, so again, a bear market is defined as a drop of 20% or more from the all-time highs. Okay, and a question you might be asking, and I get this a lot here, especially with the weakness that has shown up, is well, how long does it last? How long does the bear market last? And on average, you could see here that they last about 9.6 months. All right, so if we round that up, 10 months. And that's since 1929. So if we go back to the Great Depression. And when we are in a bear market, on average, if we're talking about averages, the decline on record for the average is about 36%. Okay. So in your average bear market, it's not just going to be, okay, we came down 20%, we're good, we're coming back up. No, the average is actually lower than that at 36%. And can it go lower? Yes. And there's historical precedent for that. Now, one of the most extreme cases is if we go back to the Great Depression, right? 1929 through 1932, the S&P 500 fell 86%. I mean, that's intense. That's crazy. The most recent largest drop that we've had in the market, you'd have to go back to 2008. That was the Great Recession. And I think we dropped about 56% during that time. So the bear markets can be pretty powerful, pretty damaging for people's retirements, long-term wealth. And just to tally up, if we go back from 1929 to current day, which is almost 100 years, there have been 26 bear markets. So just think about that for a second. In almost 100 years, we've had 26 bear markets. So what does that tell you? That they're not the commonality in the stock market, right? They're you don't want to call them rare, but it is not as common as bull markets. So keep that in mind that even when you have a bear market, they present opportunities for those who are patient and who are ready to take advantage of those down moves. Okay? So that's your bear market. Now, the less intense version of a bear market, which is what we are currently in here in the S&P 500, is a market correction. All right? And while a bear market is 20% or lower, a market correction is a drop that's going to be 10% from all-time highs, all the way down to 19.9%. So whenever you hit that 20 threshold, you're in bear territory. And as of right now, I think, and we'll look at the charts here in a few minutes, we came down, I think 10.43 or 10.48% is the low. So we have entered correction territory. Okay. Now, on average, market corrections occur about 1 to every 2 years. Again, which is not that often, right? It's just more evidence to show that, we're in a bull market more often than not. And their average duration is going to be anywhere from 1 to 4 months. And so if you take a look at where we are right now, it's been about 28 days that we've been correcting. And we had a little bit of a pop today that might continue. But if we are going to continue to correct, if this is just a retest, we could be in this drawdown period for, a longer time. But just because the average is 4 months, that doesn't mean that we're just going to be in a straight drawdown for 4 months, right? It can be shorter than that. When we talk about the average drop in a market correction, we're looking at about 13%. And this is a key statistic too. And this is where it's so hard to tell or to say, all right, this isn't just a correction, this is going to be a bear market. But about 63% of corrections do not turn into bear markets. All right. So just because we've dropped 10% or a little bit lower than 10%, that does not mean we are headed into bear territory. And here's the one thing I'll tell you about right now at this moment in time. We have been on a significant bull run since the bear market lows in October of 2022. And we have just really ran straight up off of artificial intelligence, excitement. Big tech has driven things up. And we have not had a market correction of 10% or more on the SPX since 2023. And you'd have to go back to July of 2023 to October for our last correction. So all of 2024, all of last year, we did not correct 10% on the SPX. So the markets are due. Okay. So, most people expect for the markets to just go straight up. It just doesn't work that way. Okay. All right. So here's just some data around bear markets in history, just showing how far they can drop. You can see the dot-com crash here. This is when everybody was just putting a .com after the name, pets.com, hotdogs.com, chewinggum.com, and there was no substance behind those businesses. And what we saw was a 49% drop over 31 months. So almost half, right? So put that into perspective and think about what the fear that probably induced in people when looking at their investments, looking at their retirement accounts. It's pretty scary. But notice it lasted 31 months. And then what happened? It recovered. Okay. I talked a little bit about the great financial crisis, 2007 to 2009. This is when they were giving all those mortgages out that they should not have. And that didn't work out very well. The banks became insolvent. They didn't have any liquidity. And we saw a 57% drop in stocks over 17 months. But what happened? Market recovered and went higher. Then you had the COVID crash of 2020. That wasn't that long ago. So this was this was actually the fastest bear market on record. 34% drop in 1 month. And we'll look at this on the chart. But if you would have bought this dip here, you would have made so much money. And I want to show you that. So again, think of bear markets and market corrections as opportunities, not, oh, the world is ending, the sky is falling. That's just not the case. You have to be patient, but these are opportunities. And then the 2022 bear market, the most recent one, this should actually be 27%, and that was over a 9 month period. That again, that was because of high inflation, um, high interest rates, raising those interest rates. And again, bear markets occur approximately every 6 years, but frequency varies. And so just keep this in mind. We had bear market in 2020, one in 2022. Could it be that it's every 2 years that's what we're on now? We don't know. It's impossible to predict. But what we can do is just make educated and informed decisions about where we are now. Recovery from bear markets. How long does it take to get out of these funks, right? On average, it takes about 22 months to get out of a bear market. And you could see the largest rebound here followed the great financial crisis, and we went up 150% from there. So again, it just shows the opportunity that exists after you have these drops. And then when we talked about COVID, and this is where I said you could have made a lot of money here, 120% after that 1 month dip, right? Of 30, what was it, 34%. And then check this out. The average bull market lasts 2.7 times longer than the average bear market. But you don't hear people talking about that. When you turn on the news, when stocks are down, it's, oh, the market's crashing, it's terrible, it's horrible. But bull markets last almost 3 times as long as your average bear market. And keep this in mind too. The best days in the stock market often follow the worst days, reinforcing the importance of staying invested. And so here's the other thing to keep in mind too about bear markets is you're never just going to go straight down. It's never just going to drop straight down. In bear markets or even in market corrections, what you're going to have is a drop from the highs, and then you'll typically have a retest. And a retest just means a bounce, right? Where people are covering shorts, where people are buying at levels they think are values. But those bounces are short-lived because then the downtrend will continue. But then what will happen again? You'll get a retest because shorts are covering, people are buying, but then what will happen? You'll come back down. And so it'll be a series of drops, retests higher, drop, retest higher, drop, retest until it finds a bottom. But the reason why I wanted to point this out is because these rallies can be very fierce. And if you're a day trader, if you partake in day trading, you can make some significant profits off of those. So just wanted to point that out that rarely will you just go straight down in a bear market. Okay. So how do you navigate bear markets, market corrections? And it's pretty straightforward. Stay invested because missing the 10 best days in the market can drastically reduce your returns. It's scary, but it's if you just look at the charts like we will here in a few minutes, that if you stay invested in the long run, the market always comes back, right? It's going to test your patience. It's going to be scary because you're seeing a lot of red, but markets are designed to go up over time. The other things you could do is focus on quality stocks. Now is not the time to buy penny stocks or speculative stocks, meaning companies that don't have a proven track record or that don't have a product with strong demand or future value, but your companies that have been around forever, like your Apples, that are not going to go bankrupt. I'm sure the majority of you have an iPhone out there or something similar. Um, your companies that or Exxon Mobil, the companies that are part of the fabric of culture. Those are the companies that you want to stay invested in. Okay, so during downturns, that's where you're going to find greater value. You can also use a strategy known as dollar cost averaging. Some people refer to it as DCAing or DCA, dollar cost average. And basically, what that means is as the stock continues to drop, if it's a company you want to own, instead of buying it all in one shot, saying, oh, this has dropped really far, I'm going to just load the boat here, you buy gradually as it continues to drop. So let's say that we had, I talked about those relief rallies, something like this. You might say, hey, I'm going to buy a little here. It dropped a little bit more. I'm going to buy a little bit more here. It dropped again. I'm going to buy more here. It dropped a little bit more. I'm going to buy more here. That is what is known as dollar cost averaging. Okay. And so as you're buying on the way down, you're accumulating shares at a cheaper price. So when that uptrend resumes, you have a nice average price that's low and you could capture on that upside when it returns. Okay. The other thing that you want to do when we are in these types of down moves is just pay attention to what's happening in the economy, things like the yield curve, unemployment, the Federal Reserve policy, what's happening with companies' earnings. And I want to spend some time just talking about this here now because this is really the cause of the weakness that we're seeing in the markets. So if we just back up a little bit and we go to 2022, that is when inflation was very, very high, and the Federal Reserve had to raise interest rates to put pressure on inflation to bring prices down. Okay, so there for a longest time, and even still now, we have restrictive policy, which means that it costs a lot to borrow money, which puts pressure on the consumers. I'm sure some of you see this with, interest rates on credit cards, if you're getting a home loan, those types of things. And inflation was starting to come downward to the Fed's goal of 2%. The challenge right now is the new administration is implementing tariffs on other countries, reciprocal tariffs, and by nature, tariffs are inflationary. And so, because the market doesn't know what type of impact that's going to have on inflation, there's uncertainty. And if there's one thing the market despises, it's uncertainty. And that is why you're seeing the market sell down. And so until there's a clear picture and a clear understanding of how tariffs are going to influence inflation, there's going to continue to be market weakness. Okay, so that's the one thing that's really driving the downward pressure on stocks right now. It's the tariffs. So if you are an investor or if you are a trader, I would encourage you to stay informed about tariffs, about news around tariffs, reciprocal tariffs, or if China is placing more tariffs on the US, what the relations are between Canada and the US, Mexico and the US, other countries, because as that becomes resolved, you're going to see less pressure on stocks and that uptrend resume. All right. So I wanted to point that out. And again, remember, um, bear markets, market corrections, they recover. Okay. And this last little component here about market corrections, the 80% of market corrections recover within a year without turning into bear markets. So really the key takeaway here is these are not permanent things. This is this is temporary. It's not something that's going to stick. It's not something that's going to stay. It's uncomfortable, but you have to be able to ride that out. All right. And so I'm just going to pull up the charts here and we'll just take a look at a few things. I'll just show you some history, put some charts to the data that we looked at. And here's the SPX right now. All right. So S&P 500. And you can see from these all-time highs, on February 19th that we have corrected down here to about 10.4%. All right. Since then, we've had a little bounce out of that area. And uniquely enough, um, when we first hit 10% here on Tuesday, March 11th, you did get an initial bounce, but see how it sold back down, right? But what we want to watch for now is okay, here's that retest I talked about. And all these lines that I have on my screen, these are what are known as moving averages. And you could see that we have a 200-day simple moving average here on the screen, this yellow line. And more than likely, what's going to happen is this SPX is going to retest this 200. And here's where we want to watch to see what happens. Can it push through this and continue to climb higher? Or will this be a rejection spot and it's going to come lower? And just to give you an idea, 12% would bring us down to 53.89. And if you're wondering where bear territory is, we'd be coming all the way down here to 48.93. All right. So we're quite a ways away from bear territory. But just to show you, that's where we would have to arrive. And that would take us back to prices we were in February of 2024. Okay. One ticker that I want to show you where we actually currently are in a bear market is Bitcoin. So Bitcoin has just been on a massive run. And this hit an all-time high on January 20th of 109,000. And you could see that Bitcoin is below 20%. It actually got down to almost 30%. Here's the line for 20%. So Bitcoin right now is in bear territory. All right. Doesn't mean it's going to stay there for very long, but just to give you an idea. Now, let's just go back and look at some history here. So I talked about the last correction that we had, right? So first of all, just look at this run that we've been on, right? I mean, that is straight up. That is straight up, and nothing can just continue to go straight up without some rest. The last time we actually have dropped 10%, it's right here. So this was July of 2023 into October of 2023, and we corrected 10.88%, and that was over a 92-day period. All right, and I remember this because people were saying, "Oh my, we're headed into a bear market," but then what happened? We bottomed, and then we just ran up. Okay. If we go back, let's go look at the last bear market. Here's the last bear market, right? We were up at all-time highs in January of 2022, and you could see how we dropped to the October lows of about 27%. And here are those retests that I was talking about. So you come lower, you retest, lower, retest, lower, retest, lower. Okay, so remember, it's never just going to be straight down. Now let's just keep backing up a little bit so I can show you more examples here. Here's the COVID bear market right here. Look how fast this was, right? I mean, this was a huge buying opportunity. Here's when COVID hit, and that was over a 32-day period, 35% drop. But then look at this massive run out of here. Hold on, let me pull this up. Look at that. If you would have bought that dip, this thing just ran higher, right? But again, it's so impossible to tell those things. Here's a little market correction back in 2020 over 22 days, a little 10.56% correction. And then what happened after that correction? It ran up, right? So again, this was probably very scary for investors and traders at this time, but the market continues to do what it does. It goes up. Just go back. I just want to keep showing you more examples. I'm just trying to show you that these things are not permanent. Here's another one. 2018. This was a 20.15%. You would have to call that a bear market because it's 20%, but that lasted 86 days. And then what happened? It smashed higher before COVID hit. Here's an 11.96% correction, 19 days, and then it ran back up, right? So these things always recover. Here's a few more corrections here in 2015. in 2016. So here's a 12.59% correction that lasted 36 days. Here's a 14.35% correction that lasted 100 days. And then you see what follows here. Again, so the data doesn't lie, the charts don't lie. There are always recoveries. Right? Here's another 10.94%. Now, here's the housing crisis drop. This is 2008. This is that 57.35 drop. And this one lasted 504 days before it made new all-time highs, right? So this one did last quite some time, but again, it recovered. All right. And so the last thing I'll show you is just here's the monthly chart on the SPX, just going back from the beginning of time. And you could see, and I know my chart's a little messy, the market goes up. All right. So despite the sell down right now, despite the pressure that's on stocks and equities because of what's happening with tariffs and the uncertainty around inflation, just remember that the data shows, the hard evidence shows that these periods do not last. And you have some specific numbers to accompany this to show to you, to prove to you that this will eventually be a blip on the radar. We will see a recovery, but I did want to share that with you guys tonight. And then I wanted to open it up to questions for all of you to see if I could help answer or clarify any questions that you may have. So I'm yours to help you out if you have any questions. And I'm giving wait time because I know you guys have to type in the chat. Or maybe there are no questions. So tell me this, so I can at least get some uh just some confirmation. Have I paid much attention to XRP? So Daryl, I have a little bit. I mean, we could pull that up here on the chart real fast. Let me pull it up here. XRP. Make sure that's not the market cap one. I have I do have a little XRP. I don't have a huge position in it, but really it's kind of been following the same kind of pattern that Bitcoin has been following. The one beneficial piece for Bitcoin, crypto, really all altcoins is just the deregulation that's occurring, the strategic reserve that's been created. And because there's been just such a massive run for crypto since November, there naturally has to be a period of cooling off. And so what's happening right now on XRP with Bitcoin is just really some defensive posturing, some profit taking. You're seeing people being a little bit more risk off just because of the uncertainty with tariffs. But what should happen, even if we just go take a look at Bitcoin too, because that's really the standard. You've had periods like this before where you've had drawdowns, right? These highs that were made in 2021, and it could pull back quite significantly, but then you see these rips out of here. So we could see a little bit more weakness come for crypto, for Bitcoin, for XRP. But once that's over, once that retest is done, again, if it just follows historical patterns, both XRP and Bitcoin can move much higher. Yeah. Yep. So Anthony asks, are politics playing a role in the markets? Yeah. So, like I said about the current administration and President Trump with the tariffs, They're inherently inflationary. They do drive up prices for consumers because it puts pressure on companies. Companies have to pass that increase in cost on to consumers. And so that's going to put pressure on the consumer, which then is going to cut into businesses' earnings, and that's where the uncertainty comes from. Right now, what we're seeing is the market does not know how to price that in, um, because we have to see earnings play out. And until we get some really clarity on that, we won't know. And that's why I think there's probably a little bit more room to the downside to come. So yeah, politics do play a role in that. Um, so again, there's just a lot of uncertainty right now surrounding economic policy with the tariffs. So that's why I would encourage everyone just to stay informed about it. Doesn't mean that you have to, be reading everything about tariffs, but just pay attention to any news or any new types of tariffs that have been put out there, reciprocal tariffs. And the other thing to pay attention to as well, and this is it's crazy, is, if there's a tweet out there from President Trump about tariffs, you will see, or if he makes a comment in an interview, typically you'll see a move that occurs right away on the charts. So the markets are very, very skitsy and sensitive to tariff information, and it'll probably be that way for some time until deals are worked out between the U.S., Canada, Mexico, and China, to where there's some type of harmony between the countries. Um, do I think that Bitcoin is correlated with the stock market? Yeah. So typically, what you'll typically see Bitcoin, whatever Bitcoin will do first, and then stocks will follow. So Bitcoin actually started dropping before stocks did. So that doesn't mean that we're going into a bear market because Bitcoin's in a bear market, but after Bitcoin started dropping, because it's considered a risky asset, stocks started to drop. So notice that you're seeing, today we had a decent little bit of a bounce here on Bitcoin today. Again, it doesn't mean anything yet because you've got to push through these moving averages. But you'll typically see you'll Bitcoin is almost a front runner for what's going to happen for stocks. So if you see Bitcoin start to really, really push and start to get back up into 100K, watch stocks to see if there's a corresponding following move. Okay. A favorite, Tesla bargain now, Elon in the news, time to buy. So I'll just tell you from my perspective, I'm not buying anything yet. I don't. I'm not convinced that we're done dropping. Now, I may miss out on an opportunity. I'm comfortable with that, but I think that there may be a little bit more weakness to go, just across the board. I don't know how much more, but I'm still being cautious. But yeah, I mean, if you look at Tesla, Tesla is in a bear market from its all-time high to where we are now. It's corrected 55.72%. It's filled this gap from October. But there's so much backlash against Tesla right now that this thing could come a little bit lower. And my target is, if I could get it down here at the 100 SMA on the monthly, this 148.24, I would be willing to go long here. And it was down in that area last April. This is typically this time of the year seasonally is tough for Tesla. So I would wait on this one, before going along with Tesla. But that's just me. I'm waiting on things. I'm waiting for more certainty to come out in the market before I go long. But again, that's just me. That's not financial advice. That's just my current take. Do you consider tariffs as a form of market correction itself, leveling a playing field? It could be. Um, you know, the the there are some people out there who believe that the current administration is trying to force a correction or even a bear market or even a recession to bring down interest rates. And not just the Fed funds rate, but also mortgage rates. And in case you didn't know this, mortgage rates are tied to the 10-year treasury bond. So that's the chart that I have up here. And you can see that this has been dropping here recently. So as this 10-year treasury bond comes down, this actually puts pressure downwards on mortgage rates. And this is a result of what's occurring. So is it true that they're trying to force a correction or a bear market and put pressure on the 10-year? Possibly. But we know that we've been in a high interest rate setting for quite some time. It has tied up the housing market. People aren't willing to purchase homes at these prices. So by putting that downward pressure on it, it could lower rates and spike the housing market, but it could also raise inflation. So, question here is when there is a bear trend like we are now for day trading, do you enter more into short positions more than long positions? Yeah, so I mean, you should always try to trade with the trend. You know, the cliche, the trend is your friend. Um, what really you want to try to catch retests. So, we've had some upside moves here recently, but when you're in these downward moves, if you can wait to get a retest higher and then short that retest, those are good day trading opportunities. But there are still opportunities to go long too. So even though we're, in a short-term bearish trend, you could see that you do get bounces. So really, you could trade it either way, but it's best to trade with the trend. And then they're forcing the Fed to cut the rate to potentially, yeah. So, all right. Any other questions here that I can answer for you guys? Bear markets, market corrections. And I'll wrap up by saying this again, just keep in mind that they're opportunities. I showed you with the charts that these are temporary moments. These are not permanent. They create opportunity. What I would encourage you to do, if you have TradingView, if you don't, and if you're on this webinar, you need to download it. Just go back and look at the charts, examine these corrections, examine these bear markets, look for commonalities. And if you have a stock that you want to own, I know that Rajan brought up Tesla. What you could do is just identify the levels where you are willing to buy it, where you want to own it. Or let's say Meta. Meta is another one that's a company that I really like that I want to own, but I want it to get a little cheaper. But what you can do is just set levels to say, hey, all right, if this comes down to 556, this 50 simple moving average on the weekly, this is a buy spot for me. All right. And then you might just say, all right, every $15 lower, I'm going to buy a little bit more. And you're just setting up your plan, and then you follow your plan and you dollar cost average. And that's really the key, just having a plan to take advantage of this weakness because it won't last. Will not last. It doesn't because the market was designed to go up. Yeah, Joseph says sell calls. Yeah, if you own shares too, you can also sell covered calls. I would not sell naked calls because that puts you at risk if we eventually reverse and it goes higher. So, all right, ladies and gentlemen, I want to thank all of you for joining me here tonight for navigating market chaos. Hopefully, you are leaving here with a better understanding of bear markets, market corrections. Just drop a one in the chat really quickly if you feel like you have a good understanding now of bear markets, market corrections. All right, that makes me happy. If I can help you with anything, you probably friends with me on Facebook, or you can email me, couragepaysbetter@gmail.com. I hope you guys have a great night. I will send this video out to all of you tomorrow, and I appreciate you joining me here this evening. Take care, everyone.